Learning objectives. After completing this module, learners will be able to understand that money is an intermediate good which is acceptable to both parties in any transaction. Understand that one has to consider the trade-off between the advantage of liquidity and the disadvantage of the foregone interest in order to decide how much money to hold at a certain point of time. Understand that the transaction demand for money of the economy is nothing but a fraction of the total volume of transactions in the economy over the unit period of time. Learn that the number of times a unit of money changes hands during the unit period is called the velocity of circulation of money. Understand why the interest rate is usually thought of as an opportunity cost or the value of holding money balance. Learn that the reserve deposit ratio or RDR is the proportion of all the total deposits commercial banks keep as reserves. Learn that the credit worthiness of a person is judged by her current assets or the collateral, which is a security pledged for the repayment of a loan she can offer. Learn that the money multiplier is the ratio of the stock of money to the stock of high-powered money in an economy. Learn that the system of guarantee assures all individual account holders that their banks will be able to pay their money back in case of a crisis by the help of central bank. Understand that the RBI purchases or sells government securities to the general public in a bid to increase or decrease the stock of high-powered money in the economy. Learn that an increase in the stock of high-powered money is equal to the total liability of RBI. Learn how RBI undertakes an open market sale of government securities of an amount as equal to the amount of foreign exchange inflow in the economy in order to keep the stock of high-powered money and total money supply unchanged. Rules and procedures of money. Money as a medium of exchange. Probably the premier function of the money is to work as a medium of exchange to facilitate transactions. Without money, the transactions can be conducted through barter system, which requires the direct exchange of the good and services for another. It necessarily removes the problem of double coincidence of wants as being served as medium of exchange, which all transactions do generally accept by everyone irrespective of their individual requirements and choices. Money as a unit of account and store of values. As a unit of account, money also acts, which is a common measure of the values of the exchangeable goods and services. Both the suppliers and purchasers become capable to make decisions about quantity of the good for supply and purchase by the aid of the knowledge of values of the goods in the scale of prices. As a well-satisfied medium of exchange, the money essentially holds the values over time, thus it works as a store of values. On the contrary, if the money would not be able to be stored for the period of time, despite remaining valuable during exchange, the problem of double coincidence will be forcing there, and such a way it could not retain as a medium of exchange at all. Money as the standard of deferred payments. As a means of standard deferred payments, money performs too. For example, the rupee in India, being a unit of account, is regarded as the standard of the carried over payments or simply future payments. Money is the settled object globally to remove indebtedness and for scaling the delayed and future payments too. By the virtue of money, the loans and any type of future contracts have been made. The demand for money. Definition of liquid assets, which can be owned and be exchanged into cash with ease, is called an asset. In the case of property, we need to sell it in order to get cash value as equivalent with the market rate. Regarding real estates, if it is sold in premature time, loss can be incurred. On the contrary, for funds, we have them in bank accounts which are invested in CDs, and thus it can be converted into cash without any complexity. These are called liquid assets. Transaction motive of holding money. We need the money only for the simple reason as it can bring the necessary goods and services for us. Between the expenditure and the receipt of wages or salaries or incomes, a difference exists. The income acts as a primary cause for the demand of money in transaction. This is affected by the factors of various levels of business activity and the type of receiving the income as well. Speculative motive of holding money. The investor or trader used to hold the cash in order to gain the best investment opportunity at the time when it arises in future. Eventually, an investor always wants to conserve a decent amount of liquidity in his or her portfolio. By discussing the speculative mode, we can show those people who tend to hold their wealth in the form of bonds or cash balances. The anticipation of the changes of the interest rates of capital value of assets like bonds basically drive the people to hold their bonds or cash balances for future actions. The supply of money in a modern economy. Demand deposits. We can say that money is demand deposits too, along with becoming currency and coin. These are used to check the accounts as held in several depository institutions. However, they are the commercial banks in general. It has become too complex in modern economy while we indulge to measure the money in actual mode, because there are numerous varieties of financial assets being present in the economical transactions which perform as like as money in several forms. Fiat money and legal tenders. The fiat money, being a commodity, has the lesser value than as the money. For an example, if the money is made of solid gold, it will not be fiat money. That is, it means that a mode of declaration, which can be seen in the cases where the government declares a national currency in order to recognize as the globally accepted means of exchange. Generally, the government of a nation declares its own national currency to be of legal tender in order to be made it well accepted for the payments for every type of public or private debt inside the country. Eventually, the money can be seen as a debt and the supply of money as the distinct form of monetization. It means that we can see our demand deposits and currency holdings in the form of money which is monetized. On the perspective of the bank, the demand deposits are the liability and thus being as a debt, and the account holders must have their money to withdraw as well. Narrow and broad money. From the calculation where M1 or M0 is the narrowest or most confining forms of the money and becomes the ground for the medium of exchange in the economical transactions, we can find the concept of the narrow or broad money. In general, the M1 and M2 depicts the narrow form of money, and M3 and M4 signifies the broad money. The M4 shows the largest way of money supply. The broad money includes several deposit-oriented accounts which would take at least 24 hours or more to get the maturity and thus being capable to accessed. A specific duration of time is required in these cases. Thus, they are entitled as longer-term time deposits. Money creation by the banking system. Currency deposit ratio, reserve deposit ratio, and statutory liquidity ratio. The interactive relationship between the amount of the cash a person holds and the amount he or she maintains in readily accessible accounts depicts the currency deposit ratio. The formula refers as. On the other hand, the amount of money which banks must have as cash with the proportion with depositors' balances creates the reserve ratio. The central bank of the country, like Reserve Bank of India, determines this requirement time to time. By a given time period, the reserve ratio impacts upon the money supply in a country. In India, the commercial banks are required to maintain a distinct amount in the form of cash, gold reserves, government-approved security bonds before giving credit to their customers. This reserve requirement is called the Statutory Liquidity Ratio or SLR. In order to restrain the expansion of bank credit, the Reserve Bank of India determines the rate of this ratio in different situations. Bank rate and repo rate. For borrowing and lending activities performed by various commercial and central banks in the country, repo rate and bank rate are calculated. These are the lending rates at which the Central Bank of India would lend the funds to other commercial banks. Although both of these rates are eventually used to control the cash flow in the market, but they are not equal in nature. High-powered money and money multiplier. The increase in monetary base directly results a huge increase in the supply of demand deposits through the loan giving of the banks, and thus it is regarded as high-powered money. Under a fractional reserve banking system, the money multiplier generally holds a close relation in different monetary ratios between the commercial and central banks in a country. Monetary policies and roles of Reserve Bank of India. Deficit financing through the borrowing activities. Total amount of money stock becomes always greater than the volume of high-powered money in the economy, which is created by the commercial banks through giving the fragments of their deposits as loans or investment credits. In Indian context, the deficit financing refers the budgetary deficit, which ensures the creation of new money, adding to the existing money supply in the economy. At the point of economic crisis, Reserve Bank guarantees the loan amounts on the behalf of the commercial banks and ensures the insolvency accordingly. Consequently, this is regarded as a last resort, being the lender in the economic system. When government needs to print money in case of budget deficit, at that time, the treasury bills and government securities and bonds are usually kept by RBI, and then it issues the currency in return. The new flow of currency then becomes gradually the component of money supply in the economy. Open market operations and varying reserve requirements. In order to reduce the supply of high-powered money and its monetary base, RBI can introduce an open market sale of various government securities of its own holding in the reverse order. The varying values of cash reserve ratio and statutory liquidity ratio tend to change in the values of reserve deposit ratio, which alters the volume of money supply in the economy. On the other hand, bank rate policy and sterilization by RBI. The changes in bank rates drive the changes in the decision of the commercial banks in case of borrowing from RBI, which in turn, the greater or smaller portion of their resources they give out as loans to the borrowers or investors. It is one of the prime objectives of RBI to disinfect the economy against the untoward external blows, which is called sterilization. Summary. Let us summarize what we have learned. In a modern economy, people hold money broadly from two motives, like transaction motive and speculative motive. The money acts as the unit of account and the storage of values beside performing as the medium of exchange. Supply of money consists of currency notes and coins, demand and time deposits held by commercial banks, which is classified as narrow and broad money according to decreasing order of liquidity. The transaction demand for money of the economy is nothing but a fraction of the total volume of transactions in the economy over the unit period. Under competitive assets market condition, the price of a bond must always be equal to its present value in equilibrium. The number of times a unit of money changes hands during the unit period is called the velocity of circulation of money. The interest rate is usually considered as an opportunity cost or the value of holding money balance. The currency deposit ratio or CDR is the ratio of money held by the public in currency to that they hold in bank deposits. The total demand for money in an economy is composed of transaction demand and speculative demand. A high bank rate makes the borrowing of money from Reserve Bank of India costly and consequently encourages the commercial banks to maintain a healthy reserve deposit ratio RDR. The reserve deposit ratio RDR is the proportion of the total deposit commercial banks keep as reserves. The credit worthiness of a person is judged by her current assets or the collateral, which is a security pledged for the repayment of a loan she can offer. The Reserve Bank of India acquires debt bonds or securities as issued by the government and pays the government by issuing currency in return. The money multiplier is the ratio of the stock of money to the stock of high-powered money in an economy. The system of guarantee assures all individual account holders that their banks will be able to pay their money back in case of a crisis by the help of the central bank. The RBI, as the Central Bank of India, purchases or sells government securities to the public in a bid to increase or decrease the stock of high-powered money in the economy. An increase in the stock of high-powered money is equal to the total liability of RBI.